I'm Tom Harwood, today with a significant development that's set to impact millions across the UK. The Bank of England has today announced a cut in interest rates down from 5 to 4.75%. This reduction marks the second reduction of this year, following August's cut from 5.25 to 5%. Now let's break down what this means for you, your finances, and the broader economy. Let's set the decision in its context. The Bank of England's Monetary Policy Committee voted 8-1 in favour of this cut. The decision comes on the heels of some surprisingly positive news on the inflation front. UK inflation dropped unexpectedly quickly to 1.7% in September. That's the lowest level in 3.5 years and below that 2% target from the government. The Conservative Party argued at the time this was thanks to their stewardship of the economy, including tough decisions on public sector pay deals. But of course, it's the new Labour government that is claiming all the credit today. Lower inflation, of course, means that interest rates, the tool that the Bank of England uses to control inflation, can come down too. There are more factors at play here too than the headline rate of inflation. Recent statistics have shown that wage growth has slowed to its lowest rate in over 2 years. So this combination of falling inflation and slowing wage growth has given the bank confidence to ease monetary policy, hopefully spurring more economic growth. But what for the impact on mortgages and homeowners? Well, your first question might be, how does this affect my mortgage? Well, the news is generally positive, especially if you're on a tracker or variable rate mortgage. Figures from Totally Money show that monthly payments could drop by £32. That's £384 annually. And if you combine this cut with August's previous rate reduction, tracker mortgage holders could benefit from total savings of £63 per month. That amounts to a considerable £756 per year. Not an insignificant sum at all, especially with the cost of living still high for too many families. However, it's not all smooth sailing, of course. Despite this rate cut, some lenders have actually raised their mortgage rates. Yes, Virgin Money and Halifax, for example, have increased their fixed rate deals by as much as 25 basis points, 0.25 percentage points. This seemingly contradictory move is partly due to the recent budget announced by Chancellor Rachel Reeves, which has led to an increase in government borrowing costs. Despite the cut in mortgage rates today, the long-term trajectory of rate cuts have been lengthened by recent decisions from the Chancellor. Yes, let's get to that budget factor. It's crucial to understand how it's influencing the broader economic picture. The Office for Budget Responsibility, known as the OBR, has found that the recent budget could leave interest rates 25 basis points higher than they otherwise would be over the course of this Parliament. Why? Well, it's the £70 billion package of extra tax and borrowing measures announced in that budget. It's expected to place upward pressure on prices. In simple terms, more government borrowing means higher inflation. The Bank of England itself has forecast that the budget will increase inflation by up to 0.5 percentage point over the next 2 years. This is a delicate balancing act. On the one hand, the budget aims to stimulate economic growth, although the 5-year growth forecast is actually lower than the OBR's previous assessment in March following the budget. All this borrowing that the Chancellor gambled on raising growth prospects, on the other hand, risks stoking inflationary pressures, which could lead to higher interest rates in the long term. So what are the implications for savers? Now, while borrowers on variable mortgages might be breathing a sigh of relief, savers are likely to see reduced returns following this rate cut. Savers who rely on interest to supplement their income may feel overlooked if these rates continue to fall. Currently, the average rate for an easy access savings account is around 3%. With this rate cut, we're likely to see these rates fall further. So if you're a saver, it might be time to shop around and consider locking in higher rates while they're available. For some, it might be time to look for investment options that rely less on interest. Let's look at the property market outlook now. For those of you interested in the property market, whether as homeowners, potential buyers or investors, this rate cut could have significant implications. Lower interest rates typically stimulate the property market by making mortgages more affordable. This could lead to increased demand, potentially driving up property prices. For landlords and property investors, this could mean higher rental yields and increased property values. However, it's not just about that rate cut, of course. The recent budget and ongoing economic uncertainties are also playing a crucial role. Nicholas Mendez from mortgage brokers John Charcoal suggests that market expectations have already adjusted, with forecasts now suggesting 2 or 3 rate cuts in 2025, down from earlier predictions of 4 or 5. That's why those fixed rate mortgages, those costs are going up. The broader economic picture. Well, let's zoom out and look at the bigger picture here. The rate cut is part of the Bank of England's strategy to stimulate economic growth while keeping inflation under control. Governor Andrew Bailey has stressed that whilst progress is being made, it's not mission accomplished yet. The bank now forecasts that inflation will return sustainably to its target of 2% in the first half of the year 2027. Now that's a year later than previously thought. This extended timeline is largely due to the inflationary pressures expected from the recent budget and its billions in extra borrowing. But what of the international context? It's worth noting that this decision doesn't happen in isolation. Other central banks will be setting their own interest rates. These international factors can have ripple effects on our economy here in the UK, influencing everything from the value of the pound to investment flows. So, what's next? Looking ahead, the Bank of England has indicated that future rate cuts will be gradual. They're walking a tightrope trying to support economic growth without letting inflation spiral out of control. For homeowners, especially those on variable rate mortgages or coming to the end of fixed rate deals, now might be a good time to review your options. Consider whether fixing your rate could provide some stability in these uncertain times. For savers, the advice is clear. Shop around. With interest rates potentially on the decline, it's more important than ever to ensure that you're getting the best deal you possibly can. And for the broader economy, we'll be keeping close eyes on inflation trends, wage growth, and global economic conditions. These factors will all play a crucial role in shaping the Bank of England's decisions in the coming months. In conclusion, while today's rate cut provides some immediate relief for borrowers, the long-term economic outlook remains uncertain. The interplay between monetary policy, fiscal measures, and global economic trends will continue to shape our financial landscape. But for now, that's all. I'm Tom Harwood for GB News. Stay informed, stay financially savvy, and don't forget to hit that subscribe button for more.